You know, in a world that feels like it's buzzing with economic anxiety and, frankly, a lot of global tension, there's one area that's been this weird island of calm, and that's the U.S. housing market. So let's get into it and figure out exactly what is going on here.
So that's the big question, isn't it? With everything happening in the world, especially the conflict with Iran, you'd think the market would be in chaos. But housing? Nope. It's telling a totally different, much quieter story.
And when I say quiet, I really mean it. Despite all the headlines last week, the key numbers, we're talking sales, inventory, even mortgage rates, they barely budged. It's kind of strange when you put it up against the rest of the economy.
Just let that sink in for a second. While other markets were lurching all over the place, housing just sort of kept on keeping on. It's this incredible stability that makes this whole thing so fascinating. So what's propping it all up? Well, first up, it all starts with demand. The first big pillar holding this market steady is that buyers are definitely coming back into the picture, and the data is making that clearer every single week. So a great way to see this in real time is with pending home sales. And now that all the weird data from that massive January snowstorm is out of the system, we're finally seeing what's really happening. Clear year-over-year growth, a much healthier picture.
And this isn't just a one-off. We're talking about a 3-week streak of growth. You know, it makes total sense when you remember that mortgage rates have been hanging out below 6.25% all year long. That kind of stability gives buyers the confidence to get back in the game.
Okay, now let's look at another piece of this puzzle, mortgage purchase applications. This is a big one because it kind of tells the future. It shows us sales that are going to close in the next month or two. And get this, last week, they were up 10% compared to the same week last year.
And what's really wild is how consistent this has been. We've had 8 straight weeks of positive growth, and 5 of those were in the double digits. If this keeps up, we could literally be looking at several 100,000 more home sales this year than last. That is a big deal. But look, strong demand is only half the story, right? To really get what's going on, you have to look at the other side of the coin, supply. And this is where we got a bit of a curveball last week.
Yeah, you heard that right. It went down. This was not supposed to happen. Right now, this time of year, we should be seeing inventory go up as we head into the spring season. So this dip is completely against the grain.
And this slowdown in growth has been nothing short of dramatic. I mean, at its peak last year, inventory was growing at 33% year over year. Last week, it was just under 7%. If this trend keeps up, we could actually be in negative territory by early April. The market is getting tight.
And to make things even tighter, new listings, so the fresh houses coming onto the market, they're also down compared to last year. So fewer new homes plus falling inventory, well, that means we've got a much tighter market than a lot of people were expecting.
Okay, so demand is up, supply is tightening. But what about the money? What about the cost to borrow? Let's peel back the curtain on this hidden force that's been keeping mortgage rates so incredibly stable.
So the key thing you got to understand here is something called mortgage spreads. The simple version is this. It's the gap between the 10-year Treasury yield, which is like the base rate, and the mortgage rate you and I actually pay. When that gap is wide, rates are high. When it shrinks, rates come down. Simple as that.
So, why are we talking about this? Well, check this out. If we still had those crazy high spreads from back in 2023, the average mortgage rate today wouldn't be a manageable 6.14%. It would be over 7.3%. The fact that these spreads are getting back to normal has been a massive gift for homebuyers this year.
Basically, these normalizing spreads have been a giant shock absorber for the market. They've soaked up all the wild swings from the bond market, keeping our mortgage rates surprisingly low. Now, most of this good news has already happened, but it's been a huge positive for the housing story in 2026.
All right, so the internal guts of the housing market, they look pretty solid. But there is this huge looming threat from the outside that could just throw a giant wrench into the whole thing. And we have to talk about it. We have to talk about oil.
This quote really says it all. The analyst we followed drew a line in the sand. If oil prices went over $82 a barrel because of the conflict, it was a signal that things were getting out of control. Well, last week, prices didn't just cross that line. They blew right past it, hitting $92.
And this isn't some far-off threat. We're feeling it right now. A nearly 42-cent jump in gas prices in just 1 week, that is one of the top 10 biggest jumps ever. And that hits every single one of us right in the wallet. And remember, this is so much bigger than just the price at the pump.
Higher oil means pricier airline fuel, more expensive diesel. And since trucks use diesel to haul pretty much everything we buy, that drives up the cost of food, clothes, you name it. It's a ripple effect across the entire economy.
So we've got this picture of a strong internal market, but with a major threat from the outside. So what does that mean for you? What should you actually be paying attention to over the next few weeks? Okay, here's your game plan. First, and this is key, the most important economic data to watch right now isn't housing data. It's the price of oil. How the conflict with Iran plays out is the #1 variable, period. And second, when the next big existing home sales report drops, you got to remember it's still going to look artificially low because of that January snowstorm. Don't let the headlines freak you out.
And that really just leaves us with this final thought. For all of its internal strength, the solid demand, the tight supply, the fate of the housing market might not even be in its own hands. It's a powerful reminder that sometimes the biggest risks are the ones that come from way, way outside the system itself.